Hi, and welcome to the Market Alert for Monday, 9th of September 2019. So, stocks and bond yield rise on trade war hope. Commodities collapse most in 28 years. This is Friday. This is not good news for the Fed. This in particular, the last part, this is bad enough, but the final part of this headline is not good news because the Fed want inflation. The more they can have inflation, the better off the debt looks, and they're not getting it. The only way they'll get that is with helicopter money and circumventing the banks so that the public go out and spend. So don't hold your breath. Anything's possible with these central banks now. After the last 10 years, anything is possible. So Friday, let's have a look at the daily chart first. You can see that we continue to move higher. The non-farm payroll figures, they came out slightly lower. Again, the reason the market's taking no notice of this is because of Trump's tweets. And I've mentioned this for many weeks now in the Market Alert. And I'm just going to digress just for a second and show you this, that JP Morgan have launched the Vol-FIFI index to track impact of Trump's tweets on market volatility. A fascinating article that if you're interested, go and have a look of the impact. And as I've said for many times now in the Market Alert, that the economic data that we used to view as sacrosanct, you'd be out of the market at 1:30 if there was a major impact news item, and so on. And now it doesn't matter because the market's taking no notice. It's become political as opposed to economical. They're not looking at the economic data. It's staggering. So anyway, thanks to Trump's tweets, the market's managed to come off the 200 bar moving average in the daily chart and continues to move higher. Let's just mark up a 76% retracement in here from the high to the low, and let's just drag these across. You'll see we're through the 62%, but the 76% retracement there is the important one. It always is for me. 62 is interesting, but 76 is very important. You can see there 26,842. The market sitting in this area on the overnight market at the moment. Friday, again, the beauty of the 200 bar moving average. You can see how the market moved lower. I'm just going to drag this across a bit for a second. Let me just activate it. And you can see there, this is the news on the non-farm payroll. This sent the market lower because it wasn't at the expectation. But as soon as we get into the cash market after 2:30, the market is brought immediately back above the 200 bar moving average, and this is where prices then remain. Come back and test it. Beautiful test there. You see the buying coming back in, and then the market moves higher and drifts lower into the close of the session. Overnight Sunday, again, market down to the 200 bar moving average and holding above the DP level as well. Let's have a look at the news. GDP for the UK. This may affect the pound slightly because obviously the economic news in the UK and political news, obviously at the moment with Brexit, and today being another one of those days where the Queen should sign off the bill for no deal, bringing it into law later today. If she does, it will certainly be interesting. Then we'll see what impact that will have on the pound. But just to finish off with the Dow, the next upside target is the 27,179 if the market heads this way. But certainly in the US, assisted by the Trump tweets. That goes without saying. Okay, in the pound for Friday, again, weakness in this market. We can see a 76% retracement here. I'll draw it in for you. And just so you can see, you become sort of used to seeing this pattern and aware of it. And if I just drag those across there, you'll see the market comes up to 76, fails to hold, and then moves to the downside there. And then breaks the 200 bar moving average. Prices have gapped lower because of the Brexit stuff in the background. and no doubt will continue to remain weak as well. Even though it's being spouted on the mainstream news and used as a counter argument to remain, we can see that the pound isn't anywhere near the lows that it put in a few weeks ago, down on the 3rd of September. If we mark this up, just so that we've got a point of reference here, 119.58. And what I would also be inclined to do, now the market's turned and closed back below the 50 bar moving average, is draw in these there we go, draw in the 62 and 76% retracement there as well, just so you can get an idea of where the market's likely to come down to. 120 would be a psychological level there for this market, which is also down towards the 76% retracement as well. Meanwhile, in Bitcoin, if we start off with the daily chart, a bit weak at the moment and gone quiet, which is typical. We've had a good run, but at the moment the market's stuck in a sideways range. It's clearly defined here. You can see the shape of it here, you know, so we could see another retest of the lows here before moving back up, or remaining this way for a while in a consolidated way. Otherwise, we may just move to the upside or continue to the downside there. But certainly a clearly defined sideways movement. And stepping back and looking at the bigger picture, the market's currently holding above the 20 bar moving average. And again, I'd be inclined to go from this low to Thursday's high and have a look and see what we've got before we hit these lows, where we could find some sort of support in this market. And I'm just going to draw in the low here as well, so that we've got a good idea, and this way we can keep up to speed with what's going on there as well. In the 4 hour, again, the market is sideways in the shorter time frame, and once again we're back below the 200 bar moving average. You can see the market attempted to come back through it and failed miserably, and has now moved lower, so it's struggling. There's definitely weakness around at the moment, because each attempt that we've seen where the market's managed to get above, it's then been sent back to the downside in the 4 hour. So this market weak at the moment for sure. And in the 15 minutes, it's been fairly quiet until over the weekend, until we see, I'm just moving it back here to the 7th, which is Saturday, the market moving up to the 200 bar moving average, trades sideways, breaks through on the overnight only to return through. It attempts to come back through a couple of occasions here. We've got a bit of a double top there, and then the market's shaken out violently, as we can see here during Sunday's session. And at the moment, the market back through the 200 bar moving average. And one thing that I've observed is to play, if you want to play the game of trading back up to the 200 bar moving average, instead of waiting for it to close above, find support and then move higher, is to monitor what's happening as the market is moving lower, for example. So we've got this low in place, and what I would do here is just mark up a 76% retracement. If the market holds at this level and then closes back above the 20 bar moving average, comes back and sits on it, then there's a chance we may move back up towards the 200 bar. Something that I'm looking at the moment, because obviously something happens where the market always seems to trade back to the 200 bar moving average, and there's only a certain set number of scenarios. It's not as complicated, and by observation, the market will either hold at the 200 bar, it will go through, and then it will come back, sit on it as support for the buy side, and conversely the opposite, it will find it as resistance, move back to it, and either go through, come back through, or touch it and then move back through as well. So it's an interesting pattern of what actually happens, but the 200 is a major psychological level for the market because it is used so broadly. That's why it seems to have this pattern that we've seen and observed over the last year or so inside of the market alert. Okay, let's have a look at the final few bits and pieces before concluding. Okay, let's start off with the implied volatility. This is for Friday. We can see that it's dropped slightly from Thursday 1626 to 1616. Not a great deal given the fact that the market is trying to rebound here. So again, the options sellers are not convinced of this up move. That's what it's saying to me. And then if we look at the visuals of it, we can see that we're still bullish because we're above the 20 bar on with regards to the Dow prices and below the 20 bar with the Dow volatility there. And then with regards to Deutsche Bank, this is continuing to remain above the 200 bar moving average at the moment. This has certainly been ramped up. There's been some assistance here from the central banks, no doubts about this. We got close to the 640 and then we moved back up all the way to $8, $1.60 rise. And then finally the yields remain the same. The data's not up to date. We haven't got Fridays yet. They've not released it, but they've released up to Thursday, minus 0.5. 0, so yeah, recession en route. Simple as that. There have been recessions without an inversion of the yield curve, but there's always been a recession with the inversion of the yield curve. Okay, that will do it for this one. Let's see what happens today. Keep an eye on them Trump tweets, and as ever, thanks for watching. See you in the next one.